Okay, if you could all come in and take your seats, get ready for the keynote. Thanks very much. Just let everyone wander in. Okay, my name is Michael Casey. I'm a managing editor in foreign exchange markets at Dow Jones and the Wall Street Journal. And it is my great honor to introduce to you Jim Trott, your keynote speaker this afternoon. Jim has spent 32 years, or did spend 32 years, at the Bank of England. And if any of you were reading closely in the program, you'll know that Jim was in that position as chief dealer of the FX market at the BOE on September 16th, 1992. Black Wednesday, for those of you that are familiar with this event. The fact of that meant that Jim can probably quite rightfully claim to be the person who single-handedly bought more sterling than any other human being in one single sitting. It was a big event, not one that historically we look upon as one of England's greatest achievements, of course. George Soros might feel a little differently, and Jim may have mixed feelings about that event. But it's interesting now, if you look back 20 years later, 21, will be 21 years this year, to look back and question whether or not it actually was such a bad thing for England after all. Clearly, it was a seminal event that really dictated to a large extent whether or not the UK would join the Eurozone. And we, of course, know what's happened to the Eurozone in recent years. There's other questions to be asked about sterling and its future, of course, and Jim will, I think, among that and all sorts of other interesting issues, address for us. So without further ado, let me get Jim to come to the podium and give us the keynote address. Thank you.
Thanks very much. Ladies and gentlemen, good afternoon. Before I start, I'd like to thank very much the people at Shift FX. I think that they've done a wonderful job in this, their first attempt at organizing a conference. I think it's been as good as any that I've been to. I'd also like to thank, for getting me here, the people at FXDD Frontier. Now, before I really get into the gist of this, I just want to tell you a very quick story because it kind of sums up the way that I think about the euro. This story originated in Ireland, but now is told across the UK, whereby there's a guy minding his own business, sitting in a field on a fence, and somebody comes along and asks him for directions. Strokes his chin a couple of times and then says, well, if I was you, I wouldn't start from here. Now, that's precisely the way that I think about the euro. Now, as Michael mentioned, I stand before you this afternoon as a Brit, but not any old Brit, one who has been badly damaged by wrongly depending on the might of a corporate Europe to come to the rescue of a nation in financial trouble. I refer, of course, to that infamous date in September 1992, the details of which I'm not going to go into. However, I mention it only because it was the most recent confirmation of the fact that when one gets involved in these mechanisms, they don't always work in the way that they should. When you look out for the cavalry, you don't even see any dust. In our case, that was the Bundesbank, and it's odd that the focus now falls once again Germany's way to perhaps save the system. No doubt what you're going to hear over the course of the next 3/4 of an hour or so about the euro and about the prospects for Euroland. There is no answer, at least not one that anybody here can give with any certainty. When asked the question, will the euro still be here in 10 years' time? And if so, in what shape will it be in? The dilemma, as I see it, is that the euro simply cannot fragment, because the repercussions that would happen to the world economy, a world economy weakened by the events of 2008, it would really struggle to handle those repercussions. But at the same time, it simply cannot stay together, because the pressures on the southern European countries of having to adjust to currency discipline that clearly is proving untenable for them doesn't work. Therefore, irresistible force meets immovable objects. It may have come to your notice that just last year, the Nobel Peace Prize for 2012 was awarded to the EU. Now, I think that this is both interesting and significant. It emphasizes to me that the macro goal amongst the founders of the Euro project, of which, don't forget, the Euro is just the latest iteration, that their high-level strategy was to look for peace in Europe after, let's face it, a history which has been littered with conflict. Now, at the time, it was certainly envisaged that there would be difficulties along the way. However, those difficulties very much came second to this macro goal of achieving peace, the most important thing. However, when people now go to the ballot boxes in Europe, it's not upmost in their thoughts. Upmost in their thoughts is preserving the dignity of themselves and their families. And I would also perhaps argue the fact that, that from a macro point of view, the major imperative for Europe is not now peace after the truce for the last 60 years, but in fact is now power. Europe's leaders see, I think, that only a collective GDP with the size of a united Europe can any way in the future seek to challenge and talk on an equal footing with the likes of the USA and, of course, the emerging markets. Being simple about these things, the main determinants of the value of the euro, to my mind, are very simple. The North, the core countries, let's call them, need the continued membership of the Southern European countries to act as a counterbalance in terms of value. Without the countries from the South, the euro would almost certainly be a lot stronger. At the same time, the countries from the South love to be the members of a club associated with such wonderful people as the German Republic, but find the problems with that, in other words, the value of the euro, immensely difficult to cope with. I believe that had all the countries in the euro had to go through the same form of pain, which has become evident in places like Greece and Spain, the common currency would not now exist in its current state. Simple fact is that Germany and its satellites have experienced considerably different and certainly less disruptive economic consequences over the past few years than has been the case elsewhere in the Eurozone. Core countries up to now have been broadly very happy to see their money flow south because the benefits that have accrued to them have been net positive. This is de facto to me what elections have said so far, but it's become obvious in different moves. You could refer to the Cyprus issue as being the German government perhaps justifying a little bit more to their electorate that we are trying to get something out of this. Because otherwise, how much more money flowing south will the electorate put up with? The probability, I would guess, come next September, when you have German elections, is that another pro-European coalition will come out of that. I wouldn't say who's the leader of it, but a pro-European coalition will probably be the result. Now, this works in Germany's case, obviously, as I've just pointed out, simply because before these elections in Germany, the politicians will make it crystal clear, once again to the electorate, just how much Germany has to lose should the common currency fragment. Most importantly, that message will be heard because the population has seen nothing like the fall in living standards that are experienced elsewhere. No riots yet in Berlin. Continued government-imposed, EU-inspired personal fiscal hardship in the South has caused huge problems. Now, I'm not going to regale you with the same old statistics that you've heard lots of times, enough to say that GDP is exactly that. It's a statistic. Unemployment and poverty are what ruins families, causes crippling unemployment, and emasculates governments. What's really been noticeable to me has been the lack of a coherent opposition. In the UK, when we have austerity, you have an opposition. You can vote for someone else. This is denied at the moment to the people in Greece and Spain. There hasn't been an opposition which has risen up. Maybe until recently, when you've just seen this extraordinary man from Italy garner something like 25% of the vote. I think by following the current path of imposing austerity on these countries, I find it almost impossible to envisage a meaningful recovery taking place in the South. And I'm not happy about this, unfortunately to me, is the portent of many more riots on the streets. I think that people will get up and say, for us, this just doesn't work. Maybe you're seeing the first sort of signs of that. And particularly, I'm interested in Catalonia. I think that bears watching very quickly. So to summarize at this stage, I can't see any lasting recovery taking place if policy remains unchanged. And I can't see the people of the South putting up with this quack remedy of austerity in response to every virus. Now, as I just touched on, I think it's quite easy to see how the core countries attach conditions to every piece of austerity which is passed down to them. It's very popular amongst the electorate to know that painful, imposed austerity is now demanded to make these people pay for what they see as the profligacy of the past. My fear is that the time frame necessary for this medicine to take effect is too long for the pain being inflicted to be regarded as temporary. Now, take your minds back to just last summer, round about last June, July. The market was then convinced that the euro in its current state was finished. And the only question was really who would leave? Would it be Greece? Would others take the opportunity to leave with Greece? And what would happen? The market conclusion then that the state of the euro was untenable, I agree with. The people who said that Greece would leave got it wrong, not because the fundamentals within the euro probably dictate that something like that will happen. What they didn't get was the will of governments to keep this system together. I think what happened then was, of course, to relieve that situation, you had the ECB come in with remember the legendary big bazooka. In fact, the ECB, of course, did nothing. The ECB made a lot of threats, and that was enough to move the market, and things returned to the comparative calm of the last few months. However, of course, nothing happened to change the substance of the euro. Nothing happened to change the lack of competitiveness which is in the euro. Now, I'm not a great fan of PPP, but it's just interesting I just read some numbers, and it's something like 105 for Greece, 119 for Italy, excess of 153 for Germany. Just gives you an idea of how diverse this euro has become. Now, this is not a problem that's going to be resolved in the bond markets. Intervention, words by the ECB, it's not enough to resolve the fundamental problems. It will be resolved, if it is to be resolved, only by greater monetary flows from the north, greater mobility of labor, much more efficient taxation systems, and the acceptance of further austerity. The prospect of better economic times ahead for the populace of Southern Europe is the issue. And the issue further is whether that is going to be possible, or whether that's more likely within the euro system or whether it's more likely out of it. That, to me, is the core issue. European democracies are not governed by markets and bond spreads, but by the people. And I think it's very important to understand that. So let's just very briefly waltz over to the dark side. What might happen should someone like Greece leave? Very, very easy to say. Very, very difficult to actually pick through the consequences, and I'm certainly not going to do that in any detail. First, as you are all aware, there is no mechanism for this. When the euro was formed, it was considered that it would show weakness to have any plan B at all recognized. Therefore, there is no mechanism. It doesn't mean it's impossible. Again, make that very clear. I think a revised euro, and the problem is I don't know how long that will be after someone moves, because there will be lots of doubt, and I think that that's the biggest issue that we might face. A revised euro, if you do lose some of the countries at the bottom, would eventually get stronger. That's the easy bit. What happens to the person, or the country that leaves, is stunningly complex. However, that alternative, damaging and traumatic as it would be, becomes much easier to bear if, in the view of the electorate, the current system offers only long-lasting despair. Just swiftly return to that demon date of 1992. Now, the exit from the ERM of the United Kingdom was followed by a very sharp depreciation of the currency. It was also in the backdrop of a very accommodative monetary policy. This was a very unusual policy mix then. However, the groundwork then laid the framework for a period in the latter 90s, which the UK did very well on that basis. So people often ask, well, why isn't it just as easy for one of these countries just to leave? The fact is that that they would leave, they would have a devaluation, and it would be pretty much like the UK experienced. Unfortunately, certainly regrettably, the situation is now so exceptionally complicated. Of course, we didn't have to change our currency, but the situation apart from that is so enormously complicated that any breakup would unfortunately be anything but clean. Contagion would certainly be inevitable, and at the forefront of any sovereign state withdrawal, emergency capital controls would have to come in. Legal issues of existing debt and contract obligations would be pretty hideous. So I return to my earlier statement. Too fractured to continue, but too important to fragment. My conclusion is that the situation in at least one of the peripheral countries will become so strained politically that an exit from the euro in the medium term will take place, despite all the negative implications, as much as to give hope as anything else. If this does happen, other fringe countries will, of course, look very, very closely at the success of that particular venture before considering their future within the euro. I know, and I hope I've made it clear, that this will be anything but an easy path to take. It will be impossible to do the planning for it in secret, and global uncertainty would lead to huge disruption in the financial markets. But I think without change, hoping for better times is realistically just that, hope, without any real chance of success. Any exit would probably have to be sought by a sovereign nation, and it would have to be with the approval of the other countries within the EU. At least this would serve to lessen some of the problems that would arise legally. Now, eventually, if we get back to what it should have been in the first place, a group of core countries whose economies have converged, then I think the move towards greater fiscal and political union would then take place. Impossible to put a time frame on this. All prudent governments I know have already done work on the possibility of someone leaving, how it would affect them internationally and domestically. Many academic papers have been written about the possibility of such an event. So as I've said, the trauma with leaving the euro would be considerable for the world for a considerable period of time, and there's no way, no matter how well that exit would stage, to mitigate that. The euro, however, as it stands to me, looks untenable. I think that national opposition to membership will strengthen. If, as seems likely, recessions deepen and extend, something is going to have to give. I think, as a last thought, I think austerity is the right medicine. The world has been living beyond its means for a long time. This is coming home to roost, particularly with consequences in Europe. Austerity is the right medicine. The probably is that austerity, or the medicine in itself, is slightly toxic. If it's applied for too long, then the medicine will kill the patient. Pass you back to Michael. On that happy
Really
note.
cheery. I was going to say. Right. Thanks for that uplifting talk, Jim. That's
one of the
we're all going to need
happiest
a
I've
drink
ever
now,
given.
aren't we? You know, come on. That's, I was told that you're an entertaining, light-hearted, fun
Yeah,
fella.
that's what it was. Such a dry subject.
It is. It's very hard not to address it. Look, I wrote a column today about similar sorts of things, and so I'm as guilty as you are of being a downer. But let me bring Bob Savage in here. Bob, of course, is Chief Strategist for FX Concepts and CEO of Trott.com. Look, there's an enormous amount of material for us to chew on. Thanks very much for that, Jim. I had a set of questions that I was going to throw at you, and the first one was precisely about the outlook for the euro. But so you've given us some material there, but we've also just had, of course, this spectacular bungle of Cyprus trying to resolve its bank recapitalisation, and which has put back onto people's radar screens this prospect of an exit. Now, it doesn't seem to have immediately had the same broad fallout across markets, but my question would be to both of you, is this a signal? Are we now, quite apart from the question of whether or not there is going to be an exit at some point, we've gone through a quite lengthy period of remarkable calm thanks to the words of Mr. Draghi. Are we now at an inflection point where we have to start worrying about all this sort of market nervousness and contagion? Is this back on the table, and how does it play out? Maybe Bob, I'll go to you first.
Even though markets seemed sanguine about Cyprus today, I think that the genie's out of the bottle. But the principle of Cyprus is far more important than the economics. It's a tiny country. Perhaps with too big a financial center. But the principles that are being fought, whether Germany is allowed to dictate the terms of the size of the financial center outside of their control, and how deposits are treated in the EU, really is an issue that may well splinter and lead to, maybe the Cypriots will give up on the euro. I would argue that the country that has the most to gain from exiting is actually Italy. The CDS contracts for Italy allow them to devalue and move from the euro to the lira again, which is not the case for Cyprus or Greece or any number of other countries. So there's less of a pain trade there. The manufacturing center that Italy has would benefit from that. So I actually have my eyes peeled and surprised by the market lack of concern about Italy not having a government. But then again, they haven't really had a government since World War II consistently for a long time. So this is nothing new. What we are seeing is the ability for the market to accept the fact that nothing ever changes. And that gets back to Jim's main point, which is about growth. And I think that's really the story about why is the US, which has the same set of problems after 2008, doing better than Europe? And it's simply one point. Even though everyone hates it, and I'm as guilty as the next. I have Goldman Sachs on my resume. There's no doubt in my mind that the success in the United States was TARP, keeping its banking system intact, and the European version was, we're sweeping this under the rug. The bondholders of bank debt are sacrosanct, and no one takes a loss. Well, you can't square the circle. The problem in Europe is that they have a credit crisis still. The banking system is not working, and that has all the recessionary turning into depression era mentality, and the depression is forgotten. But that is what we're headed towards in Europe.
So when, Jim, do we see the markets actually start to price in this risk again? I mean, at what point do people start to focus on some of the really strong points that you made, that there really is this growth problem Bob referred to, and just a serious malaise amongst the people of Europe? Look at these Cypriot bankers, Cypriot savers. I mean, These are really angry people, and as you say, they're the ones who will ultimately decide. Surely the markets have to price in that risk, but they seem to be focused very much on the magic words of a central banker who yet hasn't even done anything. When does that shift?
The thing that really disturbs me about the Cyprus issue is the fact that I think Bob had this phrase last night, the 17 people sat in a room and came up with this idea. And everyone thought, wow, what an uncontroversial solution that will be. That'll go down well.
How easy.
I find it extraordinary, and when you are as broad a Eurosceptic as I am, when you see these decisions make, it plunges you even further into go, oh my God, what are these guys doing? So when the market will price these things in, I think it's really difficult for the market to grab a hold of. It's not hard for the market to grab a hold of the fact that it will probably break up. It's hard to grab a hold of what will be left afterwards, because what will the euro look like? Will it justify a stronger rating? Will it justify a lower rating? It will, of course, tend to trade lower as uncertainty travels around. But on the breakup, be very, very careful. I don't think that there's going to be a huge euro sell-off because the timing is such a problem. But I just want to see what's left afterwards.
I'm not sure that, the other angle about this, Jim, that you started with peace as being the primary objective of the euro. And
of the Eurozone, rather.
Of the EU.
Yep.
And it seems to me that the persons that probably would get the most out of leaving the Eurozone right now would be Germany. Because if I were German, I certainly would not want to pay the bill. They're a quarter of the GDP, and they seem to have 100% of all the liabilities because they actually are growing and everybody else is being tortured. So in my mind, the Doppelmark is actually the one that is in the back of everyone's mind about this Euro exit problem, which is, okay, well, the core of Europe is going to be Germany plus, other fiscally disciplined and appropriate Germanic-like states. Maybe it's not. Maybe it's just get rid of Germany and everything else falls into place, and you devalue the currency appropriately.
But it's a country that has proven how important exports can be. It drives of this.
50% of their exports are to Southern Europe, and this is the whole travesty of the idea why Germany is going to elect a pro-European government. It's going to be Merkel who's going to try to say, I'm pro-Europe, and the opposition, which is to say, I'm even more pro-Europe. They have everything to gain by this. The weakness of the currency has helped them. The openness of the markets in the South has helped them. They basically single-handedly were able to destroy all competitors in Europe to their benefit as a manufacturer of choice.
Right. So surely leaving, though, would just throw that out.
Exactly. So it is an irresistible force to stay together, and they'll pay the bill. And ultimately, how are they going to pay the bill?
Right.
Well, they're going to, like every other country in the world, live with a little more inflation than they'd like.
What did someone say? A little bit of inflation is like getting a little bit pregnant. It's very, very difficult.
I somehow managed to leave my question list up here, so let's just come back here. But on that note, I mean, the euro itself, we've seen the crisis play out in bonds. We've also seen it play out at various times in the currency markets, but we got up to 137 just a few months ago. At a time when the rest of the world, Japan in particular, are embarking on this, this new quantitative easing aggression. And here's Europe, the ECB in particular, sticking to a fairly firm posture that is enormously keeping the euro strong. Surely, with the struggle that is going on in the periphery, even a euro at 128 is too high. I mean, and does the ECB need to sort of confront this?
No, look, in order to make a difference, the value of the euro going up is going up because they need the capital. If you're trying to issue debt, the last thing you want to say in the same breath is, and my plan is to issue this debt and then devalue the currency. You don't do that. You make the currency impeccably strong and safe, not very volatile, and the monetary policy boring. So that's really the whole idea. The reason why the euro went up was because they got rid of the LTRO and didn't replace it. The banks looked like they were okay, and the debt auctions from the southern nations were going well enough. But who's not to be attracted to, in a world in the United States where we get excited about our 10-year yields at 2%, picking up Italy at 5% sounds pretty attractive. And so what? They don't have a government. Who cares?
But putting aside the value of the euro, surely, with all these other countries pursuing very aggressive monetary easing, and you yourself just pointed out that, they looked to the US, what went right? Well, they rescued the banking sector and they pumped a lot of money into the system. Isn't it time for the ECB to be pursuing a Japan-like model? I mean,
I thought it's the problem is that the conventional tools available are kind of done. In other words, monetary policy, if no one's going to borrow at 2%, they're probably not going to borrow at 1.5%. It becomes like pushing on a piece of string. So the conventional tools are taken away. The euro, I think, will devalue. I don't think it's going to go through the floor, but I think it will devalue not because of a positive move from the ECB or anybody else. I think it will go there because of a lack of confidence in the future. So I don't see monetary policy as being overstimulative at these levels. I think that the euro will come down, but yes, it's not going to be significant.
Mm-hmm. Okay. Look, I mean, one of the things that we saw last year in FX in particular, once the Draghi effect came into play, the OMT, the promise to buy bonds, was not only a compression of spreads in the bond markets of Europe, but also a considerable drop in the volatility in FX markets, both realized and implied volatility. And as it turns out, also volumes fell quite a lot. Things have turned around a bit this year. Interestingly, as markets often tend to do, in anticipation of stuff, right? So I suppose the question I have is, like, looking back at that period, not that long ago, was this a temporary moment, something to do with this transitional period that we'd gone through post-crisis? Or, as others, theoreticians would look to, there's some sort of structural process underway. And Bob, I know you've got some thoughts about the role played by algorithmic traders and high-frequency trading and that sort of thing. I mean, are there secular trends going on within the currency markets that are also getting us away from what was once a booming, volatile and volume-led world, or is this just a cyclical process?
I mean, I think it's a complicated question about why volatility and the dispersion of foreign exchange over the last 3 years was so disappointing. And I have a chart of the G10 strongest versus weakest currencies, and that dispersion last year up until November, thank you, Mr. Abe, was 11%. The long-term average is 22 over the last 35 years. And the year before that, it was 12. So there's only been one other time it's been below 20, and that's 2004. So the lack of interest in trading was in two parts. The first was a double whammy of both the ECB and the Fed really targeting spreads in fixed income. So foreign exchange is the tail of that fixed income dog. If there's no volatility in bonds, if they're pegged at zero, it's kind of hard to get too excited about where to trade your currency. That's the first point. The second point is there's a global coordination effect. I don't know how many officials from the Obama regime went over to Europe to tell them to stop the crisis now because we need to get reelected, but there were more than 3 shuttles of diplomacy going on. And the two interests of the United States and Europe to act in a coordinated fashion on interest rates and foreign exchange was clear. We want stability. We don't need a crisis. That changed after the election. And it changed in January to when the ECB kind of undid the gloves. Draghi, logically, should be cutting interest rates for the sake of Southern Europe. Yeah. And he absolutely took that off the table. And the idea that there would be another LTRO, maybe to help the banks in Southern Europe out, that was off the table. That was a very different policy message than the one that was agreed to back in July. And the gloves were off. And the US economy is clearly a question of whether the FOMC is now going to, look, they just came out with a very contorted statement as usual. Inflation's going to be lower, growth is going to be lower. Does that mean rates are going to be low? No, because we now are a job-driven market and job outlooks look like they're going to be fine. So we're probably not going to do anything on further QE or anything like that. So yeah, policy coordination globally was coordinated in the crisis, and now structurally, everybody goes your own way. Right. It's me first. Japan wants to devalue. That's fine. The Chinese have their own set of issues. They got to pop their property bubble. And this lack of coordination now after the crisis is what's driving the volatility.
Right, and then that divergence suddenly gives you the chance to trade again.
Yeah. Yep.
Right.
I think that's absolutely correct. Obviously, someone said this morning, the initiatives by Mr. Abe have significantly helped volatility. But it's also this movement away by governments, this realization that eventually we've got to get some growth somewhere. So after pressing down on inflation for a few years, now all of a sudden, we're linking inflation to GDP. We're linking inflation to unemployment. So you have got the specter of policies diverging exactly in the way that Bob said. And I think that's, for foreign exchange, provides an interesting 12 months ahead.
Let's focus specifically on Japan, because it really was a turning point. I've been covering Japan since I started covering foreign exchange 15 years ago, and it was remarkable how often they were called upon. Bernanke himself, you've got to do more. And the BOJ, bless them, would just say, no, it's a risk. They're sounding very Bundesbankian in their response. And along comes this colourful prime minister, and he's just changed the landscape. So what does it mean for the yen, though, for a role that it was entrenched in the minds of traders? It is a safe haven play. 2 days ago, at the outset post-Cyprus, all of a sudden, the yen bounced back. It was the safe haven, briefly, this week. Is that a flash in the pan? Is the safe haven over? What happens to the yen with all this?
Well, the jury's still out on whether Abe is going to be successful. In July, and in the upper house election is going to be mission critical to convincing the Japanese themselves. What we're all waiting for, all of us long dollars and short yen, or long euros and short yen, is for the Japanese to believe as much as we do. And that's going to require the unwinding of hedges in Japan. And the end of a lack of confidence in Japan. So is Abe the new Ronald Reagan of the land of the rising sun? The Japanese, I was there 2 weeks ago, don't seem very convinced. He has great approval ratings, but the jury's still out on whether he's going to be able to get the labor reform to not make this just a flash in the pan inflationary misery. And the other aspect of this is that Kuroda has been removed from his arrow of, or quiver, is this arrow of buying foreign bonds. So now you have the moral suasion argument of, well, you're going to tell the pension plans and the insurance companies to go out and buy more foreign bonds unhedged.
Right.
Good luck with that.
Yeah.
You're going to need to do something more than that.
Jim, any thoughts?
I think it's, when you look at Japan over the course of the last 20 years, and particularly the last 10, I mean, deflation has been a huge issue for them, but it is a particular issue in Japan, as much to do with the pride of Mrs. Watanabe in the strength of the yen as anything else. But when you see radical things, and I kind of like politicians that try and take hold of these things, doubling the inflation targets, 1% to 2%. Looking at the history again, look at dollar yen. Dollar yen was something like 360 40 years ago. 360 to 85. You cope with that as an economy. You know, this is a fundamental thing that's been happening to Japan, safe haven. I like to see someone getting up. I mean, everybody has been talking the Japanese stock market up as the recovery for the last 5 years. Nothing's happened. All of a sudden, someone does something about it, you get this rocket up. Is it sustainable? Let's wait and see.
Well, I mean, I think the unspoken problem about Japan is, yes, the Bank of Japan can go out and buy more REITs and more corporate debt and buy more bonds and, you know, goose that Nikkei to a degree. But the 800-pound gorilla in the region that is the key is China. And the the thing that I spend all my time looking at on a monthly basis is that China, US and China, Japan balance. And things are okay between the US and China. They're fine. But between, there's 100%, there's 100% change between what Japan was exporting to China that happened basically 3 months before Abe took over, and it's only gotten worse. The nationalism between both countries is at a level where you should be a little scared.
It's almost like there's a trade-off, right? I mean, you might be gaining a competitive advantage with a weaker yen, but you're losing it from the antagonism that comes from
and then you would move on to the next country, which would be Korea, which you know is a sleeping giant, and you know, Samsung is now on everybody's minds when 20 years ago it was Sony.
Right.
Because you know wrong.
It makes it a little bit easier in the sort of macro terms. The US and everybody else has been criticizing China about its exchange rate policy, saying that we need a much stronger renminbi. Now all of a sudden, everybody else starts to just float their currencies down a bit. It means some of the criticism is just a little bit deflected. If the criticism does come, then the guys say, what about you guys?
I think it's more complicated than just the currency world, though, because it goes back to the same problem that Europe has. It's about growth. And I look at all the places you can make money, and gee, you know, hedged investments in the Nikkei, brilliant. Last 25% return, no problems. EM, you used to be able to make a ton of money buying the BRIC EM kind of stock markets unhedged, and that's down 1% in the stock market. The currency basket itself is down. It's not a great trade, and this is the conundrum of the times that we live in, which is this beggar thy neighbor concept isn't working as well as it once did.
Right. Speaking of China, though, because it is, as you say, the 800-pound gorilla in the room, it is confronting a critical transition period, and how they go about this, how they engineer this, I think will play just a defining role in where we all head. So the big story is no longer a saver society, consumer society. Along with that, one would think, comes financial liberalization, and ultimately opening up of the capital account. This would have to be the biggest event to happen to our industry, this industry, after the creation of the euro, I would think. When do you see it happening? And how does that play out against some of these other risks that we've got?
The Chinese, the rumor is that they all agreed today, in fact, on a 10-year reform plan that gets you to this free flow of capital. The concern is that the growth of China is really based on infrastructure spending, and the ability for them to finance that has really been based on this financial repression, where you have one choice: you put your money in a bank. By the way, they don't tax savings there. They don't. Yeah, exactly. So you put your money in a bank at a very reasonable, 3%, and then if you need to borrow money from a bank, it's always going to be 6%. Oh, and by the way, inflation is targeted at 4%. So you're losing 1%. Everything's fine, and that financial repression works for everyone's benefit.
It only works, though, to the extent that you have no other option but to put it in a Chinese bank.
Exactly. So as soon as you have that window of opportunity to put your money somewhere else, bad things happen. And the social financing issue in China has really been, they've been toying with this. They're trying to get the genie back in the bottle there. Their money supply is completely larger than they expect. I mean, when copper is actually a currency, you have some problems. This is a situation where I think if you gave the Chinese an opportunity to put their money here in the United States, they'd take it. And that means that Chinese growth, by definition, is going to go down. Until China makes products where the Chinese people want to buy them, until they have their Sony or their Samsung, and you can call it Lenovo, but I think it's still IBM. If you want to do something in China to make a difference, they have to have their national brand that they believe in, that has quality, and all else follows. But
can they get there, though, without sacrificing growth in the interim?
No.
Can they maintain this? So in your view, the 7.5, 8, whatever it is this is...
I'm happy at 4.5, 5. Okay. I mean, 4.5, 5% we would kill for that right here in the United States.
Yeah, but the world's been pricing in. I mean, I'm an Aussie. Australia's price.
Yeah, exactly. That's the Australian and the Brazilian problem, because you guys have been living off of the planned financial repression growth of everybody in China has to support this. That game's over. And because it's over, the world is going to change in the way it thinks about some of the commodity demand.
So what happens? There is a bit of a shock, one would think, to the commodity currencies from that, Jim. What does that do to everything else in this kind of, this world of interlinkages and currency wars and so forth?
Too many interlinkages. It's impossible to sort itself out. I mean, with China, China will depeg, China will liberalize when China wants to liberalize, and when China wants to depeg, and when it suits China. That's always been the way, it always will be the way. China are a net exporter of consumables and a net importer of commodities. That, again, will always be the way until such things change within. So, nothing more. I mean, Bob summed it all up.
Right. Well, we mentioned the yen before. Clearly, that's been one of the big trades of the last few months. But in the last, I would say, month, one of the big trades to go short has been beloved pound. So let's enter into that sensitive area.
Yeah.
Because I think what's going on there is more than just how much time we got? Got to wrap it up? Okay. Well, let's
questions.
No questions. We just open up to questions then. Oh, we are? Okay, sorry. I'm following instructions very well. Okay, well then, you'll have to sort of track Jim down later and get his thoughts on this, but there's a lot going on, obviously, in the UK. Be interested to see how it goes. Well, anyway, thanks very much, Bob. Thanks, Jim, for a fantastic address. And thank you all.
Because they're gonna